Hello, I'm Kyle Chamberlain,
I'm Reid Neal.
and we're doing domestic currency. Reid, why don't you tell us why we chose domestic currency?
So we chose domestic currency out of all the asset classes that we could have done because really it affects everyone. Whether you want to invest in domestic currency or across to foreign currencies or not, this is something that directly impacts everyday Americans and people around the world.
Very well said, Reid. Now, quick introduction to currency. So up until about 1971, we used the gold standard, which was backed by a physical commodity of gold and even silver. Now, a great use for this is that you can only issue as much gold as you have, which eliminates inflation or deflation. The only downside to it is it does cause political unrest and civil unrest when people feel there's a shortage and then do a bank run, and the banks don't have enough gold to give them. So we actually switched to a fiat currency after 1971, which instead of a physical commodity, it now is backed by the trust of the US government. This way they can help with economic variables. So we see this now with the stimulus package, them pumping dollars into the economy, but you do get some inflation and deflation that you need to be careful about. And we can actually show this video to help explain it more.
Under a fiat money system, the government is free to create money and to lend it out temporarily to these distressed banks, so that these distressed banks can take this money and give it to the people who want to withdraw their money, thereby accommodating the temporary elevated demand for money. When people see that they can go and get their money, and there's no possibility that the bank's going to run out of money, the panic subsides. And then the short-term loans can be repaid to the government. And in this way, a fiat money system, an elastic money supply, can help mitigate or even eliminate the possibility of a bank run or a banking crisis.
All right, so essentially that just allows the government to use more policy to be able to help people get their money, so you don't have the psychological downside of having a bank run.
It's very true. We saw that with the Great Depression.
Yeah.
And we know how that turned
out. So speaking of getting your money and how everybody wants their commodities and everything like that, we'll just go into a little short deal of what is supply and demand, just the mechanics of it. Before we go into a short video about a supply and demand curve, specifically with a long-term aggregate supply, I want to talk about the difference between a real and nominal value. So when we're talking about inflation, as you were saying, or deflation, we're talking about something that is affecting the real value. So the real value is the value adjusted for that inflation or deflation. The nominal value, generally it's stuck to a year. It can be any year. The graph that I have now is attached to 1980. So that year will be set at 100, and then every year following that, the inflation since that year will be accounted for. That's why in this graph, if you look at 2009, the real and nominal GDP were close to each other. But then as you go to 2010, you can see that nominal GDP actually increased more than real GDP, meaning that the increase was more on inflation than it was in actual real goods being produced. And this video here, we'll see a little bit more about aggregate demand and aggregate supply and how that affects the long run aggregate supply.
Now this equilibrium is different. It's not the equilibrium for a market, it's the equilibrium for everything. All the things demanded and all the things supplied. The quantity represents the current GDP, the output we're producing in our country. Now just like a regular market, these curves can shift, and the result will be a change in price level and output, or GDP. So if there's an increase in aggregate demand, the price level will go up and the quantity or the output will go up. If there's a decrease in aggregate demand, the price level will go down and the quantity will go down. If there's an increase in aggregate supply, the price level will go down and the output will go up. And if there's a decrease in the aggregate supply, the price level will go up and the quantity will go down. So there's only 4 possible things that can occur. A demand shock is when the aggregate demand shifts. For example, during the Great Depression, there was a decrease in the stock market, which caused a decrease in consumer wealth and a decrease in consumer spending. This was a demand shock. Now, what about supply? If we are back at equilibrium and there's a decrease in the amount of oil that we have, that would cause the aggregate supply to shift to the left. This means price level would go up and quantity would go down. It turns out that this is the worst case scenario in the economy, and it's called stagflation. The reason why is because we have inflation, our higher price level, at the same time as a stagnant, slowed down economy. Now, all these things I've showed you are all happening in the short run. Now it's time to talk about the long run. Let's assume we're here in the economy at full employment, means our economy is at full output with 4 to 6% unemployment. The vertical line represents the long run aggregate supply, and equilibrium is right there, so we're at full employment. If there's a decrease in aggregate demand, that would mean we're now in a recessionary gap. That means our output, where we currently are, actual GDP, is less than our potential GDP, or our full employment GDP. That amount is called a recessionary gap. Now, this is going to happen in the short run, but what's going to happen in the long run? Well, we could do some sort of government policy to try to close the gap, or we can let the economy fix itself. The economy is self-correcting over time. So eventually, if we had a recession, wages will fall and the prices of resources would fall, and that means aggregate supply would shift to the right, putting us back at full employment. In the textbook, this totally makes sense, but when it comes to the real economy, we usually use some sort of government intervention to close a recession, because this might take decades. This is because wages are sometimes very sticky and they don't adjust very fast. But given enough time, the aggregate supply would eventually increase and close that gap. Let's assume we're back at full employment right here. What would happen if there's an increase in aggregate demand? Well, in the short run, our actual GDP would be beyond our potential GDP, and so we'd have an inflationary gap. Remember, this is the short run. In the long run, if there's inflation, eventually wages and resource prices will increase, and that'll cause the aggregate supply curve to shift to the left, putting us back at full employment. Now, it turns out that's where that vertical long-run aggregate supply curve comes from. It's when the economy self-corrects itself, putting us back at full employment. The trick is to remember that when there's a recession, wages will eventually fall, and when there's inflation, wages will eventually go up.
And so in that video, we see a lot of how government policy can be used to, if we're in a recessionary period, which we were in during COVID, get us back to our long-term aggregate supply. And then sometimes if the deal is trying to figure out where that long-run aggregate supply is, and that's where a lot of the debate comes around of, are we under that long-run aggregate supply or above it? Because as you saw, if we're at it and we go above that, we get an inflationary gap like we saw in 2010, where nominal GDP goes way above real GDP. There is a thing that he didn't talk about in there, where not all government spending is the same. So if government spends money, like we're about to talk with stimulus, sending out money, that's a little bit different than if they do something like an infrastructure plan where you might actually increase demand, but also increase supply so that you actually move the long-term aggregate supply, just because you can actually produce more goods because you've invested in technology and ability to make more goods than you ever could before. So just to keep that in mind as we kind of go into the stimulus.
All right, very well put, Reid. Now that we kind of gave the background of how our currency supply and demand work, we'll go over some current events. And as Reid was saying, the one I'll start with is the economic stimulus. Now, as you all know, with the coronavirus, it really affected our economy. And the US actually put out economic relief packages totaling over $5 trillion. Now, this was the American Rescue Plan and the Economic Relief Plan. Really, it was to try to get, the first one was to get people to stay at home, slow the curve. And then the second one was just to help actually kickstart the economy, get people out, spending again. This is also an example of how the fiat money system works, where we're able to pump in money where we need. So most people received, we'll say somewhere around $3,000, and of course more with kids and more with government benefits. Now, many of these people who received it they weren't actually economically affected. which we then saw a huge spike in our savings rate, as you see here by this graph, where you can see that in 2020, when we got the first one, the graph skyrocketed, then that was spent, and then once the American Rescue Plan came out, that went up again. Now, it's great that Americans are saving, but this money's not being used back in the economy just yet. People are holding on, but it does seem like people are spending more right now. So we'll move over to the Consumer Price Index.
Yeah, I think that's a good transition into the Consumer Price Index, because that's part of the problem we're seeing right now with it increasing. So there's a 12-month change that you'll see in this graph here, where you can see from March to April, it has gone from 2.6% to 4.2%. That is a 12-month change, so it can be a little bit misleading because it's based on March and April of last year. So it's the change from then to now, which those were depressed years or depressed months anyways. So that's going to affect the change. But we still saw a 0.8% increase, which is the highest increase we've seen in a month since 2008. Mostly it has to do with what you're saying. People are starting to spend their money, so they can't keep up with the demand in the market. People are wanting to spend money, and as more people demand things, the price has to increase because they can't give to everybody. For example, if an item is $1 and you have 100 people trying to buy it, but you only have 80, then you need to increase the price, because then a few people won't be able to afford it and you'll actually get more economic benefit. So that just kind of increases prices on things. And some of the biggest increases have been in the used car market. That was almost a third of that increase over in April. Also, in just regular commodities, you see like lumber has increased 124%. So it's more than double its price as of last year. And copper, which a lot of people say is a hallmark of economic activity, increased about 36%. And a lot of it has to do with supply chain bottlenecks.
Yeah, I mean, I've seen that going to the grocery store and paying the 20% more than I was used to about a year ago. And also with the used car, I've been fortunate since I'm looking to sell mine. So hopefully take advantage of that. But like you said, there's a couple more highly educated people that have strong opinions on whether or not the domestic currency is inflationary, specifically if it's transitory or not. The big argument is it here to stay longer than a year, 2, 3 years out, or is it just the short time as we're kickstarting the economy? Do you want to start us off with the arguments why it is transitory?
Yeah. So Jerome Powell, I'll quote him really fast, said higher inflation is unlikely to persist because most consumers and businesses expect mild price gains and therefore will keep their prices and wage demands in check. Global competition and online shopping also force many companies to keep prices low, factors that didn't exist in high inflation in the 1970s. He's referring to the hyperinflation that happened in the 70s. Also, as we saw in the video talking about aggregate demand and aggregate supply, wages can be a bit sticky, especially if people assume that prices are going to go back down. Also, as I said, a lot of those prices such as lumber, copper, and the used cars and trucks, it has to do with the semiconductor shortage. He's anticipating that once those supply chain bottlenecks are reduced or open up, that'll kind of bring those prices back down. But there's definitely a lot of opposition on the other side that would tend to disagree with him.
Oh yeah. First one being Larry Summers, former U.S. Treasury Secretary. He believes that the immense amount of stimulus that we have pumped into the economy will actually cause a huge positive output gap. And this output gap is when the economy is making more stuff than it's supposed to. So the economy will crank out more stuff in an inefficient way, which will create inflation. Now we see this with offering cash bonuses and large pay increases to maybe unskilled workers. that will eventually catch up with us. This other one is a video from Warren Buffett, how Berkshire Hathaway is actually experiencing inflation firsthand. So let's watch that.
We're seeing very substantial inflation. It's very interesting. I mean, we're raising prices. People are raising prices to us, and it's being accepted. I mean, it's not. If we get, well, take home building. I mean, the cost of, we've got 9 home builders, and in addition to our manufactured housing thing, and operation, which is the largest in the country. So we really do a lot of housing. The costs are just up. Steel costs, just every day, they're going up.
So what Warren Buffett was saying is that they're seeing their costs go up from all the supply they're getting, which in turn has to be passed on to us as consumers. So we are going to see it, and it's really hard to kind of get back from that. It's not like you can turn on the switch, charge us more, and then one day you go and everything's back to the way it was. And that puts me at our last argument, why it's not transitory. And this is Mohammed El-Irene. He's the Chief Economic Advisor and the President of the Queen's College. Let's hear what he has to say in this next video.
The Fed is pinning itself in a corner by insisting that this is transitory. All the evidence suggests that you should have an open mind. You just cited examples. I can cite example. Warren Buffett talked about very substantial inflationary pressure. Price increases are sticking, according to him and according to many others. You've got to keep an open mind. Unfortunately, because it is now hostage to a framework that has to be outcome-based, I think the Fed has no choice but to insist it's transitory. But I fear that this is persistent. This is not transitory.
Like Mohammed said, the Fed is saying that this is transitory, and they do have to. It's expected of them. They don't want to increase panic. We saw that a couple months ago when there was fear of the Fed raising the interest rates. So they are trying to avoid that. However, it's not something where you can just turn on and off a switch, where yes, we have inflation for, let's say, a month, and then all of a sudden, oh, never mind, it all disappeared. So based on how our currency works, how supply and demand and the current events are what's going on, I personally think that we are in an inflationary period and that it is here to stay, at least longer than the Fed anticipates. What do you think, Reid?
So I agree with you. The Fed, just to make it so that it's not worse than it is now, with things like the stock market, has to do the line of it'll stay within bounds, as the Fed wants a 2% inflation for a healthy economy anyways. But they're saying in the long run, and it does worry me that there's no time frame for what transitory means. So that can be a little bit worrisome. So yeah, I think we're definitely experiencing inflation. Everybody can kind of agree upon that. I do think that it might be transitory in the sense that as the supply chains open up and everything like that, we can see some of the inflation start to go back down, and especially as the global markets, like Jerome said, start to compete with the US. Unlike back in the day, these online markets allow for that. So I think that'll help bring things back into more reasonable bounds. But we'll find out.
Yeah, that's all we can do is wait and see.
Yeah. Thank you for watching this video and taking out your time. Hopefully this helps you figure out our situation with domestic currency at this point in time a little bit better.
Thank you.